everyone, today we're gonna talk about should I invest or pay off my mortgage? If you have received a windfall of cash or saved a sizable sum of money over the years, it may be tempting to pay off the mortgage loan early. Whether or not paying off the mortgage early is good decision or not can depend on the borrower's financial circumstances, the loan's interest rate, and how close they are not retirement. Another consideration includes whether to invest the sum of money versus paying down the mortgage. This article explores the interest costs that could be saved by paying off a mortgage 10 years early versus investing that money in the market based on various investment returns. How a mortgage loan works. A mortgage is a loan to a borrower for the purchase of a property or home when all of the legal documents are signed during the mortgage closing. The borrower signs the loan documents and agrees to repay the mortgage lender in monthly payments until the loan is paid off. Typically, the loan term is 20-30 years. In return, the financial institution pays the sellers the full price of the home and in exchange charges the borrower interest on the loan balance, principal and interest. Mortgage payments are made up of two components: interest on the loan and the principal amount, which goes to paying down the total outstanding balance. For example, a $1,000 monthly payment might have three, three 300s go to interest and 700s reduce principal loan balance. Interest rates on a mortgage loan can vary depending on where interest rates are in the economy and the borrower's credit worthiness. Amortization schedule. The loan payment schedule over the 30 years period is called an amortization schedule. In the early years, the payment for a fixed rate mortgage loan are mostly comprised of interest. In the later years, a larger portion of the loan payment is applied towards reducing the principal. The table below illustrates 5 loan payments at different intervals for a 30 years mortgage with a starting balance of 200,000 and a fixed interest rate of 3.5 point. In the link below you can see this. The table above shows that a larger portion of the fixed monthly payment went towards paying interest for the first 10 years. However, as time went on, the percentage of the monthly payment they went towards interest versus principal reversed. For example, in the 20th years, went towards principal while towards interest. For the last payment, all about $2.61 of the monthly payment went toward paying the principal balance. The portion of the loan payments that apply to principal and interest changes over the years because the loan balance is higher in the early years and smaller in the later years. This makes sense since the interest amount is higher early on since there is a larger loan balance outstanding. As the monthly payments eventually reduce the outstanding loan, there is less interest owed, leading to a smaller portion of each payment being applied towards interest and more towards the principal. Paying off the mortgage early. Some homeowners choose to pay off their mortgage early, and the benefits can vary depending on the person's financial circumstances. For example, retirees may want to reduce or eliminate their debt since they are no longer earning employment income. In other cases, people may want to free up their monthly cash outflows by paying off their mortgage. Mortgage loan examples. Let's assume a borrower has received an inheritance of 100 to $120,000 and there are 10 years left on the mortgage. The original mortgage was 200,000 at a fixed interest rate over 30 years. The table below shows what it would cost to pay off the loan 10 years early and how much interest would be saved based on three different loan rates: 3 and a 5 point, 4 and a 5 point, and 5 and a 5 point. You can link below, it's everything over there. As we can see from the table above, the higher the interest rate, the larger the amount remaining on the loan with 10 years left on the mortgage. Uh, Interest saved from paying off mortgage. For the mortgage with the 3 and a 5 point interest rate, the total interest cost by the 30 years loan would be 123.312, and the borrower would have saved 20,270 by paying it off 10 years early. Also, saving more than $20,000 in interest is significant. The interest amount saved represents only 17% of the total interest cost for the 30 years loan. In other words, 100,000 in interest has already been paid in the loan's first 20 years, representing 83% of the total interest over the life of the loan. As mentioned earlier, the structure of the amortization schedule for a mortgage leads to most of the interest being paid in the early years. Investing in the market. If a homeowner is considering paying off their mortgage early, it might be worth considering whether some or all of those funds would be better off invested in the financial markets. The rate of return earned from investing might exceed the interest paid on the mortgage for the final 10 years of the loan. In other words, the opportunity costs, meaning the foreign interest that could be earned in the market, should be considered. However, many factors go into evaluating an investment, including the expected return and the risk associated with the investment. The table below shows how much could be earned on 100,000 if invested for 10 years based on four different average rates of return: 2%, 5%, 7%, and 10%. The above investments gains were compounded, meaning interest was earned on the interest and no money was withdrawn during the 10 years period. Investment gains with loan interest saved. If a homeowner decided to invest 100,000 versus paying down their mortgage, in 10 years they would earn 22,000 based on an average rate of return of 2%. In other words, there would be no material difference between investing the money versus paying off the 3.5% mortgage based on the 20,000 saved in interest from the early loan table. Okay guys, it's all for now. You can see the continue in our next videos. Bye. Next videos, by the way, we will talk about financial planning. See you.